Hi there, very good morning. Welcome back to ET. Now you're watching Market Cafe with me, Kanishka Sarkar and Srishti Sharma. Over the next 1 hour, we'll take you through all the domestic and global cues that you need to watch out for and also tell you about the stocks that you need to keep on your radar today ahead of the start of the D-Street session. But let's get started with an eye on the globe first and see how the US markets fared overnight. The US stocks slumped wildly overnight as escalating trade tensions between US and China, they kept investors on the edge. Now, the S&P 500, that ended about 0.2% lower. That's after recovering from early losses that it saw in the session of more than 1.5%. The Nasdaq too fell about 0.8%, whereas the Dow Jones Industrial Average, that managed to close up about 0.4% higher or 203 points, led by gains in Caterpillar. Now, markets opened lower over on Wall Street after China sanctioned 5 U.S. subsidiaries of South Korea's Hanwha Ocean, intensifying global trade tensions. However, later comments from U.S. Trade Representative Jamieson Greer added uncertainty, suggesting that new 100% tariffs on Chinese goods could take effect as soon as November 1st. So stocks reacted to all of that, but they rebounded sharply through a midday. But a late-day Truth Social post from President Trump accusing China of refusing to buy U.S. soybean, that sent S&P 500 back into the red. Now, Trump has also hinted at possible retribution, including a cooking oil embargo, which rattled the sentiment further on Wall Street. Now, despite the volatility, bank earnings that offered some relief. Citigroup and Wells Fargo, they jumped about 3.9% and 7.2% respectively on stronger than expected results that they reported, whereas JP Morgan and Goldman Sachs, they also topped estimates but slipped slightly. Now, the CBOE Volatility Index that also spiked above 22, which is its highest level in 4 months, reflecting renewed investor anxiety over the deepening US-China trade standoff. So that's how the US markets largely fared. But Srishti, how are things on the crude front?
Quite interesting, Kanishka, because the oil has actually slipped on the back of the US-China tensions. It's IEA outlook that has come in, which is definitely highlighting the trade tensions that they have. Yes, as of now, Brent crude is trading with gains of almost 0.5%. So not much of a movement, but yes, the commentary and the news flow surrounding is something that will keep crude on the move, and that is something that we will be watching out for. But other than that, it's the Fed rate cut bets that has definitely markets are penciling, and that has actually gone ahead and supported the gold prices as well, because today morning as well, as we have already seen gold trading above that 4,100 per ounce mark. But for today, it's again a 1% jump coming in on the gold prices, and the record run indeed continues.
Absolutely. So that's about crude and gold. But let's get tracking some of the other top global stories that we're tracking this morning. First up, the International Monetary Fund has raised India's growth forecast by 0.2 percentage points to 6.6% for the fiscal year 2025-26, as the country's strong growth momentum is seen offsetting the impact of high US tariffs on Indian goods. However, the IMF has lowered India's growth forecast by 0.2 percentage points to 6.2% for the next fiscal year. That it has said in a report that was released in Washington yesterday. Now, IMF's upgrade comes a week after the World Bank also raised its India growth forecast for 2025-26 to 6.5% from 6.3% earlier. This is while trimming its projection for the next fiscal year by 20 basis points to the 6.3% level. That, of course, is due to US tariffs. Now, let's listen into what the IMF officials had to say about these projections for the global economy.
So overall growth in the US has remained fairly good. It's slowed down from 2024, but it's still about 2% in our estimate for 2025. But the place where you can see that reduction in the labor supply is if you look forward and you think about what is the potential growth for the US. And that estimate, of course, is very imprecise, but our estimate of potential growth in the US has been revised down as well, and that's reflecting that lower contribution from foreign labor force that was quite significant in previous years, and we're not foreseeing that it will continue to contribute. Now, the other side of this is what does it do to the rest of the world? Well, obviously, if you have slow growth in the US, per se, it's not a good thing for the rest of the world. There are spillovers that are coming from when an economy like the US is growing strongly, then it generates demand for other parts of the world as well. So something that is contributing to a slowdown in US growth is, in general, not something that is going to be good for the rest of us. The growth in the Chinese economy in the last few years has been coming in significant part from the external sector. But what we are seeing there is something interesting, which is we see an increase in volumes that are being produced, but we see increasingly a decline in the prices at which they need to be sold on markets. And that suggests that somehow the market has a limited capacity to absorb all of that is being produced coming out of China. And that suggests that that growth engine, that second growth engine itself is starting to face difficulties. So our advice to the Chinese authorities has been for some time now, it's been for many years. If you look back at our Article 4, there is a need to rebalance the growth model towards a sustainable domestic demand.
All right, but with this, let's also go to my colleague Anurag Joshi for more details.
The International Monetary Fund has raised India's FY26 GDP forecast to 6.6%, while cutting the FY27 economic growth view to 6.2%. The IMF has put India's FY26 consumer price inflation forecast at 2.8% and the FY27 at 4%. The IMF today released these numbers for India and rest of the world and the various countries and regions. The IMF has predicted that the global real GDP growth at 3.2% for 2025, and that is up from a July forecast of 3% and 2.8% in April. That comes after Trump imposed global reciprocal tariffs and a tit-for-tat escalation with the Chinese and a tit-for-tat escalation with the Chinese government ensured. The IMF said that the global growth is at 3.1% in 2026, and that's unchanged from the July forecast. It projects the UK growth at 1.3% and UK inflation at 3.4% this year and 2.5% in 2026. UK growth is forecast at 1.3%. The Chinese economy still has to get over the impact of the property sector. According to the fund, China's property sector problem is still not resolved. And the last 5 or 6 years, the global economy has been hit by shocks, and the Chinese economy needs to rebalance to sustainable growth demand in the country.
All right, thank you, Anurag, for all those details. But to get further perspective, we also caught up with Gaura Sengupta, who's the chief economist at IDFC First Bank, and R. Gandhi, who's the former RBI deputy governor, to help us understand the IMF perspective better and the forecast for the year FY26 and 27 as well. So let's listen into their comments.
We shouldn't be too bleak for next year. Yes, the full impact of the tariffs is going to be felt in next year rather than this year. This year we've got saved with the front loading. But the thing about Indian companies is, and people in general, is that we adapt to situations. For example, when the COVID shock had also come, there were very negative outlooks on growth, and the actual situation was not, in terms of economic outcome, was not as bad because individuals, governments, policies, we all adjusted. For tariffs also, I mean, it's very possible that companies adjust. They still find a way to reach the US market via other countries.
Despite the tariff announcements which has happened from the year beginning or even the moment he took over administration, despite that, global growth has been seen as growing. Their predictions, their forecast is on that basis because the nearer term, the data is a very firm data, so they're able to upgrade it. But into the distant, 1 year later, how the tariff is going to be and anything, they are looks like they are very conservative in terms of assumptions being made. So that is what is happening. Now, how India is going to perform? Yes, definitely. I would think that based on the resilience that the internal consumption demand or domestic demand is going to shape up. That will give IMF in the next round when they come out with their forecast sometime in January. They will be able to factor in that. That will bring in greater confidence in Indian economy.
All right, but China's comeback is reshaping the emerging markets, and India is suddenly not the center of the emerging market story. In the latest edition of the interview, Atul Suri explained how global money is chasing momentum elsewhere and why India may have to wait its turn to re-enter the flow.
If you look at a global player, right, if you go and sit, let's assume that you move geography. We are in India, so we are talking about India and, blah, blah, blah. But if you are a hedge fund, ultimately the flows, the fast money, one is India dedicated fund. They are going to be there, the dedicated place. But there is something called hot money, fast money, money that
rotates and
which
jumps.
moves, which is like the hedge fund plays or the opportunist plays or the momentum plays. Now they are sitting, let's say, in a global geography where they have access to multiple equity markets. Markets are up 30, 40, 50, 60% globally. Why are they bothered? As it is, they may find India expensive, blah, blah, blah,
Earnings
blah, blah.
are not coming in.
So momentum will, beget momentum in that sense of the term. Achha, leave alone equities. Then they will say, okay, let me go across asset classes. Now you have even so much happening in the commodity space. Gold, silver, platinum, etc., etc. They'll say, hey, you know what? Now cryptos have come into mainstream. You have ETFs in the US. So now they are acceptable. They say, hey, why not play that? So in this world, money is chasing momentum. And that momentum money is, or hot money, or whatever you call it, ultimately creates the trends. At the moment, India is not in that space.
Is China in that space where the rebound will sustain?
Absolutely. You see China and look at the way the EM index is, thanks to China, because it's a major driver. I mean, we are a subset of the emerging market index. And India, India was like this, and EM index was like this for years. Now it's the other way around. The EM index is like this, and India is like kind of like this for years. So, as a global investor, as I said, there is a lot of asset classes booming globally at the moment, and in that, India does not find its name. That is why you see. We all know the India big story, Amrit Kal. We all know that, right? We are the fastest growing economy. We keep saying that. Hey, but why is it not showing in the market? Is it that we know? No, everybody knows. But at the end of the day, a global investor has a lot happening in a lot more geographies, in a lot more asset classes. When India will happen, it will happen. Then flows will also come here. But at the moment, there is nothing that is visible.
All right, so that's Atul Suri's take on India's market and the rest of the emerging markets as well. But moving on and tracking some other top global stories, Donald Trump is now threatening a new front in the trade war with China, this time over cooking oil. Now, in a Truth Social post, Trump accused China of economic hostility for halting U.S. soybean purchases and said that his administration may end cooking oil imports altogether. Now, this move could strain about $12.8 billion in annual trade as both nations brace for higher tariffs and rising tensions.
And 100% tariff on Chinese goods could soon take effect, but only if Beijing escalates further, according to U.S. Trade Representative Jamison Greed. He said in an interview that Trump's move hinges on China's new export limits on rare earth minerals, which threaten U.S. tech and defense industries. Trump and Xi are still slated to meet later this month, though that could change as tensions rise.
That's true. Moving on, Federal Reserve Chair Jerome Powell has signaled the Fed may soon end its balance sheet tightening program, which is a key step that could pave the way for eventual rate cuts. Powell says that the central bank is nearing the point of stopping bond reductions as financial conditions ease, but he has given no firm guidance on future interest rates. Let's go across and listen to his comments.
Goods price increases primarily reflect tariffs rather than broader inflationary pressures. Consistent with these effects, near-term inflation expectations have generally increased this year, while most longer-term expectation measures remain aligned with our 2% goal. We could have, and perhaps should have, stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks. We knew that we could unwind purchases relatively quickly once we ended them, which is exactly what we did.
But the four major American banking majors, JP Morgan and Chase, Citigroup, as well as Goldman Sachs and even Wells Fargo, all posted strong earnings in Q3. JP Morgan earnings beat the street estimates as the lender records a rise in the profit in the third quarter. Trading division gain and recovery in the investment banking fees did also see a boost, when JP Morgan also revised its interest income forecast upwards for the year. But it wasn't just JP Morgan, even Goldman Sachs also reported robust gains in the investment fees. The figures in fact jumped 42% on a YY basis to $2.7 billion, about $500 million higher than what was anticipated. The lender's profit rose 37%, while the revenue was up 20%. Now, both profit and revenue also beat the expectations, but when it comes to Citigroup, it was a good Q3 for them as well. Higher revenue across their divisions aided the company in the third quarter. Revenue of trading as well as market segments particularly stood out this time around, and it was the best ever third quarter for the market segment, and trading revenues did rise 15% on an annual basis. Profit, meanwhile, also increased 16%. Now, Wells Fargo's profit also beat the analyst expectations to come in higher by 9% on a YY basis at $5.6 billion. But do remember that this was the first full quarter that the bank was free from the asset cap placed by the Federal Reserve. In fact, going forward, the company hiked the target for its key profitability metrics too. So all across the board, very good set of earnings when it comes to the banking majors.
Absolutely, Srishti. Very good set of earnings coming from US banking. The Asia Pacific indices, they've opened up higher, breaking ranks with Wall Street's declines after US and China exchanged blows in a renewed trade, feud. Of course, first let's take a look at how Chinese indexes are faring. Shanghai is up about 0.2%. It's, a data-heavy day as well for China. China's consumer price index for September, that has slid about 0.3% year-on-year. That's slightly faster than 0.2% fall that was expected by a Reuters polled economist. So that's about the Shanghai index. The numbers have just come out. So let's see how the market, really settles in and absorbs that, consumer price index. But moving on, let's also take a look at Japan's Nikkei index. That's also trading nearly 1% higher at that 47,277 odd level. Next up, Hang Seng Index, that's also trading in the green. It's up about, nearly 1% at the 25,670 odd level. Moving on, let's also put the spotlight on S&P ASX 200, that is Australia's index. That's up about 0.8%. That's up 68 points, at that 8,967 odd level. So that's about, the other indexes. Apart from that, there's also South Korea's Kospi index, which also is trading in the green. In fact, it's the one that's leading the gains, amid the Asia Pacific pack. It's up more than 1% at that 3,612 odd level. Now, if we talk about the Nifty, we did manage to end, above that 25,000 level, but we just held on to that 25,145 odd level. That was down about 0.3%, and we managed to end near the day's low yesterday. But if we take a look at what we are expecting for today, the Nifty implied opener suggesting a start in the green, up, with an uptick of about 81 points. So that's how the Indian market is likely to open up. An uptick of about 80 odd points is what we are expecting at the start of D3 today.
All right, so that's about the Asian market check. But back home, the benchmark indices extended losses for the second day in a row. Nifty ended below that 25,150 mark on the back of selling pressure in the PSU banks and metal stocks, wherein Sensex 2 ended nearly 300 points lower. Let me take it across to my colleague Snehi, who is joining us with the roundup of yesterday's market action. Snehi.
Well, yes, all in all, a tempered day of trade for the market, but slight recovery from the day's low, slight respite in the last few minutes. Nifty managed to close above the 25,100 mark, and in fact closer to 25,150 is at the Nifty close. Similar, a small recovery on Sensex, but nothing too material. A 0.4% cut is something that we've seen across the indices, but the broader end of the market took a bigger knock and underperformed largely compared to the benchmarks, because 0.8% cut on the mid-cap space, more than 1% cut on the small cap space is something that we've seen. India weeks 2 shot up slightly. Nifty Bank was also rather tepid. A 0.3% cut is what we saw. Other than that, the outliers on the Nifty were Wipro, Tech Mahindra, Apollo Hospitals, Power Grid, Shriram Finance, all of them closed in the green. But on the flip side, the pressure on the Nifty continued from Dr. Reddy's Labs, BEL, Bajaj Finance, TCS, Trent, as well as NTPC. Sectorally, all the sectors closed in the red, with Nifty PSU banks leading the cuts, about 1.5% lower, with names like Maharashtra Bank on the back of its Q2 earnings, IOD, UCO Bank, Central Bank, PSB, all of them seeing some cuts. This is followed by Nifty Metal, Realty, Pharma, Energy, FMCG, IT, autos and banks. Banks were the least losing sector, and autos also 0.3% cut is something that we've seen. But other than that, if you take a look at some broader market stocks that did well, the good run continued for CE Info Systems for the second day in a row. That stock was up 11.5%. Anand Rathi Wealth on the back of strong numbers was up 8.5%. You had Sona BLW, Ireda on the back of good numbers was also up another 4%. Vadi Energies, Angel One, Bikaji Foods, Force Motors, all of these stocks did very well from the broad end of the market. So that is how the market shut shop and wrapped it down. But well, yes, slight tepidness is something that we've seen. All eyes are going to be on what the recovery looks like on expiry day.
All right, so that's there. All the eyes on recovery, how it pans out for the Nifty. But time now to take a look at which are the stocks we need to keep on our radar today. And Ashesha is here with just that list. Ashesha, good morning. Lots of earnings counters there.
Indeed, lots of earnings counters, and let's get started with the IT sector first then. And Tech Mahindra has reported better than expected set of numbers. Dollar revenue saw an uptick of nearly 1.4% on a sequential basis. Dollar wins, TCV deal wins stood at about $816 million, an uptick of a solid 15% on a year-on-year basis, and rupee revenue also saw an uptick of 5% QOQ. So yes, better than expected set of numbers. Tech Mahindra in focus on the back of this. Persistent Systems, this one has also reported strong set. Revenue up 7.4% QOQ. Dollar revenue is up 4.2% sequentially, and total contract value, or TCV deal wins, saw an uptick of 15% on a year-on-year basis. Thyrocare, meanwhile, again a strong set from this company, where revenue is up 22% on a year-on-year basis. Margins too have expanded to 33% versus 27.2% that the company had reported same time last year. Cyient DLM, meanwhile, has reported a muted set. Revenue has seen a downtick of 20% on a year-on-year basis, although margins have expanded a tad bit. But the commentary continues to remain very positive. They say order intake rose by about 130% on a year-on-year basis in the first half of this fiscal, and the outlook for the second half of the year also continues to remain very positive. ICICI Lombard, meanwhile, again a weak set, where net earned premium has risen, but it posted muted GWP growth of about 1.6% on a year-on-year basis. So yes, mixed set of numbers, largely ICICI Lombard. We could perhaps see neutral to negative reaction on this counter.
Right, thank you so much, Ashesha, for that. But with this, let's also tell you which are the other stocks that are going to be in focus. We will have our eyes on Solar Vineyard because that particular company has come out with its Q2 update, where we have seen the revenue falling almost 1% on a YOY basis. But they have also flagged off a concern that Telangana retail license expiry has impacted some of their own brands. So this counter is going to be in focus on the back of that. Coalty Patil developers have come out with their sales update for the quarter gone by. Looks decent, as the sales have seen a growth of 9% on a quarter-on-quarter basis at 670 odd crores. The collections were up 8% sequentially, and the average realizations have also seen an uptick of 7%. Sattvic Green Energy, yet again in focus, one of the recently listed counters with so many order wins back to back. They have announced 2 set of orders totaling 689 crores. That's a fresh, so we will be watching out for this counter as well. An order win news flow coming in on Mishra Dhatu Nigam, as the company has bagged an order worth 306 crores. Now the total open order book stands at 2,212 crores. IRB InvIT also in focus, as the company has completed its QIP. IRB InvIT Fund completed the placement of over 54 lakh shares at 60 rupees a piece. That was at a discount of 4.2% to the floor price of 62.7 rupees a piece. So these are the counters that we will be watching out for in today's trading session.
Absolutely. Lots of counters to track today, but which are the other cues that we need to watch out for? Snehi is here to take us through that.
Well, there's lots of cues to watch out for. Back home, all eyes are going to be on the unemployment numbers as well as the trade data that will be out. Globally, lots to track in terms of macros. From US, you'll have the CPI, their inflation number out, so watch out for this very carefully, along with Fed's beige book. From Eurozone and Japan, you will have industrial production data out, and from China, once again, you'll have CPI and PPI numbers, their inflation print to watch out for. In terms of global earnings, names like Morgan Stanley, Bank of America, ASML will be coming out with their earnings, but shifting focus back home. In terms of Nifty earnings, you have Axis Bank as well as HDFC Life Insurance to watch out for. But other than this, even from the broader end of the market, a whole host of companies will be in focus, the likes of HDFC AMC, Angel One, KEI Industries, L&T Finance, MRPL, Oberoi Realty, Quick Heal Technologies, IRFC, and a whole host of other stocks to watch out for. So keep a close eye on all of them on the back of their Q2 earnings. Now, in terms of corporate action and board meetings, HDFC Life, along with its earnings, is also going to be mulling fundraising. SKF India demerger will be underway, and TCS will be trading ex-dividend as well. In the primary market, you'll have one IPO opening for subscription, and that's Midwest IPO. And lastly, in terms of some other events, ECB Governing Council members Oli Ren and Francois de Villeroy de Galou, they are going to be speaking at an event, and G7 finance ministers will be meeting in Washington to discuss the Russia issue. So watch out for all of these cues very closely.
All right, thank you so much, Snehi, for getting us all those details. But market veteran Prashant Jain sees long-term Nifty CAGR at 11 to 12%. He also sees India's valuation premium near average. Let's go across and listen into his take on markets.
I feel the markets over time should move higher. However, you mentioned one point of 15% earnings growth. I think India's real growth will be maintained. It may actually move a bit higher also. We should continue to grow between 6 and 7% in real terms. But clearly, inflation in India is a lot lower today than what it used to be in the past. And therefore, the growth of economy in nominal GDP terms, and therefore the growth of top line of companies is around 10-11% in aggregate terms. So I would not expect Nifty to compound around 15% over the next 3, 5, 10 years. My guess would be it should compound somewhere closer to 11-12%. Yes.
All right, so that's Prashant, investment officer at Alchemy Capital Management, says that financialization of savings will be a big theme going forward. In fact, he also sees great opportunity in non-lending sectors. Let's take a look at his perspective.
The number of demat accounts and the number of investors has really gone up. I still think that there is a lot of penetration still left, right? If you look at the RBI data, I think household savings into equities is still just about barely touching double digits, right? Fixed deposits are still form a very large part of people's savings. So I think this financialization of savings is going to be still a very big theme. The other thing is that the rate at which wealth is being created in this country, right? The fastest growing number of billionaires is in India. Now no longer in China. India has the fastest growing billionaire. So much wealth is being created, and this wealth will need to be managed, right? So I think whether it is asset managers, exchanges, wealth managers, I think it's a big secular theme still. There is a lot of white space to grow. So, yeah, I think there's great opportunity in the non-lending financial services, as they call it, as people get more sophisticated, more wealthy. And I think the tech layer is helping here as well, right? I mean, today if you want to do a SIP, you want to move money, it's so easy. The friction is virtually zero.
All right, moving on to another story wherein private hospital chains and health insurers are finally seeing some thaw over a regulatory reform that could significantly reshape the country's healthcare landscape. Sources say over 150 hospitals have come on board the concept of common empanelment, especially mid-sized ones, and even as the large hospital chains stay at bay for now. Anurag Shah joins in with more details. Take it away, Anurag.
So big health insurance reform, that is common empanelment, has finally started, and 150 hospitals are already part of common empanelment process, and more than 1,000 hospitals have registered for the common empanelment, and in the coming days we'll see that the number will increase for common empanelment. In a start, the mid-sized hospitals, smaller hospitals are part of common empanelment. So common empanelment means that one agreement, one terms and condition with all insurance companies. So for one hospital, there will be a one agreement with all 32 general insurance and SAHI insurance companies. So it's a beneficial for hospitals also, for insurance companies also, because presently hospitals tie up with different insurance companies for different procedure, but under the common empanelment there will be one agreement and one tariff only. As per our sources, under the common empanelment process there will be 7 to 8 categories of hospitals as per their size, as per their specialty, as per their geographical location. So accordingly only the tariffs will be decided, and every 3 years there will be change in tariff also. But in start, the big hospital chains, the big hospital groups have not shown interest in the common empanelment process, but insurance companies are saying that going ahead, the other hospitals also, big hospital chains also will come under the common empanelment, because at the time of renewals there will be a differentiation in the rates of procedures. So all hospitals will have to come eventually under the common empanelment process. So after the implementation of common empanelment process, there will be the leakages related to the claims will be stopped, the overcharging will also reduce, and it will be beneficial for insurance companies, and eventually it will help policyholders, because policyholders premium get increased because of the claim outgo only. So the work was on for the common empanelment process, and but to begin with, 150 hospitals are part of common empanelment, and by the end of this year we'll see thousands of hospitals part of common empanelment process. And as per the database, the Rohini database, there are 70,000 hospitals, so there's a long way also, but the kickstart of common empanelment has happened. So if we talk about the listed companies, then it's a positive for companies like Star Health, Niva Bupa, ICICI Lombard, New India Assurance, Go Digit, and for hospital chains it's a negative, because treatment procedures and rates will be pre-decided.
All right, thank you, Anurag, for that update from the health insurance space. But moving on, as we welcome a brand new somewhat, let's also take a quick look back at some of the key events which moved the India market this somewhat. Let's go across to Ashesha for a somewhat to somewhat events recap.
Well, yes, as we enter somewhat 2082, we decided to take stock of the key events that moved the market this somewhat. First, of course, is Trump tariffs. Remember, tariffs as high as 50% were imposed on India in the last week of August. That clearly was a big trigger for the Indian equity markets. Several sectors were impacted: textile, gems and jewelry, pharma and seafood exports, to name just a few. US and China trade war continues to escalate. We have seen a whole host of developments take place over the last few days. To Trump, tariffs clearly were a major trigger for the markets this somewhat. Second is the consumption boost, GST rate rationalization, which came into effect on the 22nd of September. And this was also coupled with the income tax relief that was given in this budget. A tax on income up to 12 lakhs was completely exempted. So consumption boost was another trigger for Indian equity markets. Third is geopolitical uncertainty, and this is likely to continue as we enter next somewhat as well. West Asia conflicts, and remember, Trump, when he came into power in January, said that he will clear all the conflict and geopolitical tensions within 24 hours, but that clearly hasn't happened. So geopolitical concerns continue to remain an overhang for the market this somewhat as well. And let's also talk about FII exodus. Remember, FIIs have sold about 3.1 lakh crore since last somewhat, and this of course is coupled with a retail inflow that continues to escalate. Now remember, SIP stood at an all-time high of 30 lakh crore in the month of September. So that clearly is on an uptrend. Let's also talk about the reasons which led to FII exodus. One is Fed action. India trades at expensive valuations as compared to other emerging markets, and risk aversion clearly are some of the other factors which made FIIs leave India this somewhat. Monetary easing also continued. Remember, Fed cut rates by 25 basis points in the month of September. This was the first rate cut that we saw since December 2024. And Reserve Bank of India also cut rates by 100 basis points in the last 1 year. Monetary easing is likely to continue in the next somewhat as well. So that's as far as monetary easing is concerned. But let's also put some spotlight on primary market action, where companies in primary market raised about 1.77 lakh crores, draining market liquidity from the secondary market. So these are some of the events, the big events that drove market.
Both PAT and revenue, they grew nearly 5% in the second quarter on a sequential basis. Top line, that came in at 13,995 crore rupees. That's higher than what the analysts were penciling in, whereas the profit, that saw an uptake at that 1,195 crore level. That sort of missed the street expectations. In fact, the tech major has also announced a dividend of 15 rupees per share. So that's how the earnings largely fared. A good set of numbers coming in. In fact, let's go across and listen in to the CEO, Mohit Joshi's comments on the company's outlook going forward.
We are honored to have been recognized by the Government of India as a key player in the prestigious India AI mission. This aligns with the country's objectives to bolster leadership in AI, to foster technological self-reliance, and to ensure the ethical and responsible use of AI. I am proud to announce that we launched Tech Mahindra, our next-gen agentic AI platform built on NVIDIA that enables intelligent autonomous execution of complex business workflows. Tech Mahindra enables global enterprises to deploy AI solutions faster, whether in assisted or a fully autonomous environments, while maintaining control and transparency throughout the AI lifecycle. On the GCC front, we extend our strengths in global capability center services. I believe Tech Mahindra is uniquely positioned to offer an integrated value proposition to global enterprises. Our deep technology expertise and digital transformation capabilities are complemented by broader strengths within the Mahindra ecosystem. I believe Tech Mahindra is uniquely positioned to offer an integrated value proposition to global enterprises. Our deep technology expertise and digital transformation capabilities are complemented by broader strengths within the Mahindra ecosystem. From world-class infrastructure through Mahindra Life Spaces and Origins, to renewable energy solutions from Mahindra Substan, and financial advisory support via Mahindra Finance. For instance, we partnered with a leading US telecom-based operator to advance its network testing and certification, automation and optimization initiatives under its long-term transformation vision. The engagement focuses on accelerating network testing and certification through a homegrown automation platform, leveraging our delivery excellence and agility to drive greater efficiency, scalability, and innovation across operations. We were also selected by a global logistics leader as a strategic partner with a multi-year framework agreement to drive AI-led efficiency and transition to a productized IT organization.
All right, so IT counters will be in focus today, not just Persistent. Tech M is also going to be in focus. Let's watch out for that. But in some of the other earnings, is HDFC Life that is all set to report its Q2 earnings. VNB margin is likely to moderate. But let me take it across to my colleague Varun Arora, who is joining us with more numbers that the street is penciling in for. Varun.
HDFC Life is expected to report 8% growth in APE on YOY basis, when VNB is estimated to grow at 3% on YOY basis, while VNB margin is expected to be moderate to 23.2%, down by 110 basis points due to change in product mix. On the last call, management said that they expect 2H FY26 to outpace H1, and for full year, FY26 growth is likely to be lower than the FY25. And the non-product part mix is projected to rise in mid-20% range, whereas par product may decline to 25% during the year. Now, what we need to watch out for. Investor may likely to focus on AP growth margin trajectory, product mix, and channel performance. And alongside, management commentary on the impact of the GST reduction to nil on individual life insurance products and its implication on growth momentum and profitability in coming quarters.
All right, so that's what the street is penciling in for HDFC Life earnings later today. But with that, we're completely timed out on this edition of Market Cafe. Srishti and I will take your leave, but don't go anywhere as the market will take all the action forward.